Time for Ask Annex. Let's get right to it and welcome our guys in. Fred Coleman, CFP and a wealth manager. Hello.
Hey, Danny.
And we got Matt Morzy, investment team manager, also a CFP. Welcome to you.
Hey, Danny.
Question 1. Thinking of opening a custodial brokerage account for my newborn granddaughter. She's been receiving financial gifts from family members. Thoughts?
Yeah, I think that's an awesome idea. Super generous of you to try to do that and put that in terms of, the long-term growth potential that she's going to be able to realize from that. So that is awesome. You really think about compounding, which, some people have called like the eighth wonder of the world. Starting out when somebody is born, just to see what that's going to be like when they turn 18 or when they turn 50, depending how long that stays in there, is going to be just awesome. I mean, that's life-changing, really. Even with really small dollar amounts right away, that is going to make a big difference. From an investing point of view, I would really keep it simple. You're really just going to want to diversify and just try to get some low-cost index funds, try to get as much of the market as possible and let it do its thing. I would stay away from I'm going to pick this stock or that stock because your return sequence could be so far off. You pick a stock that ends up going down 20 or 30%, you're really losing that ability. But just let the market do its thing, get as much of the market as possible, and just let that compound.
Yeah, absolutely. The thing about custodial accounts, they're great because you can invest in pretty much anything that you want, just like a regular brokerage account. And there's flexibility for the child once they hit 18 to do whatever they would like with the funds. Now, that is one thing to also keep in mind because once they hit 18, you do lose control of the account, so they can use it for whatever they want. They can use it for a house, a car, or if they just want to go on a shopping spree, they can do that. So it's one thing to keep in mind, you'll lose control. The other thing, and I see this with a lot of high-income earners, at some point, unearned income in those accounts do end up getting taxed at the parent's rate. There's a thing called kiddie tax. So that means that once you hit a certain amount of unearned income, it's no longer going to get taxed at that favorable child rate, but it's going to get taxed at the kid's rate. So those are two things to keep in mind. The other thing, I always like to hammer it away. If you can invest in a 529 plan, I know that they're specifically for education, but there's a lot of tax benefits to it, and then you can also maintain that ownership.
But when she's 18, she introduces Grandpa to her new boyfriend, Spike, and then they're going to go off on a motorcycle trip. She can do that, huh?
That certainly can out of the custodial account, like you mentioned, Fred. It's a lot of reason why some people will just open that account in their own name, knowing that they're going to end up passing that on to somebody else, but at least they maintain that control of when that money gets given, how much of it gets given at one point in time, and for what reasons as well, too. So you kind of balance, the benefits there.
It's Ask Annex. Next question. We have most of our cash at names the bank, which is, Matt, you'd say a good-sized regional bank.
Pretty recognizable,
okay.
Yeah.
Maybe with $10,000 at, and again, a credit union, well-recognized credit union locally, and also another one, and that's another regional bank, right?
Yeah, that one a little larger, but yeah, all of them, everybody would
Okay.
be well aware of.
He goes on to say, I've been reading about the possibility of another banking crisis. Should we be switching to the, quote, too big to fail banks versus these smaller regionals? Interested in your opinion.
First thing to look at for most people, are these banks FDIC insured? Those that you named, those are FDIC insured. So you can put up to $250,000 per depositor per account type. So you can have a single account, you can have a joint account, you can have a retirement account, you can have a trust account. That's $1 million. And you can do that at every bank. For most people, they're under that amount, so you have nothing to worry about. And the overall risk for banks failing is, very close to zero.
Yeah, there's so many protections that have been put into place on behalf of consumers, but also in terms of the stress test that the Fed put banks into is much stronger now than it was pre-financial crisis. So the risk that they have there, is a lot less. I know we did have some regional bank issues last year that created, a lot of uncertainty and volatility in the markets. But, you kind of saw that process play out in real time in terms of what the Fed's going to do, what the federal government does as well, too, in order to step in and help people out in those situations. Keeping in mind the FDIC insurance is really, really important. Other things you can do too, if you do worry about some of those things, is investing directly into treasuries, money markets as well too. You're going to see some protections there based on the underlying investments in there that you've got the full faith and credit of the U.S. government, which is going to trump FDIC insurance any day.
Ask Annex is open to anybody. You got a question for us, you head to our website, annexwealth.com. Next question on Ask Annex. This is a good one. Is regular monthly investing the same as dollar cost averaging?
Yeah, I would generally say so. Those terms are used interchangeably at some point. The idea between dollar cost averaging is investing a fixed dollar amount on a fixed set of intervals. So it could be monthly, quarterly, annually, whatever that is. A lot of people, probably the easiest way to relate to that is a 401k, where every 2 weeks or twice a month, you're having the same amount of your paycheck going into the market at that same interval at the same amount. Idea there is that the stock market does go down, you put the same amount of money in, you're buying more shares, so that as it comes back up, you're getting that reward there. But even if it's going up, you're still investing that money for the long term. 20 years from now, those fluctuations of the market are going to be something you're not even going to remember. So you really are just trying to get money into the market at a set time period. The opposite of that is trying to time the market. Saying, okay, this month I'm going to do it. Now this month I'm not going to because the market went up. Oh, the market went down. Now I'm going to try to do it again. Problem with that is the market keeps going up. We have a bunch of positive months in a row and you keep hesitating. Well, now you're going to end up buying it at higher prices. You're much better off just putting that in over time.
Yeah, the big thing is it takes the emotional side out of the investments, right? You're not worried about fluctuations. Like you said, Matt, does the stock go up? Does it go down? It doesn't matter. I'm investing. And you also will spread out the cost basis a little bit, so that helps out a lot.
That's Ask Annex. Fred Coleman, CFP Wealth Manager. Thanks.
Thanks, Danny.
Matt Morzy, Investment Team Manager, CFP. Thank you.
Thank you.